Hey everybody, it's me, AJ Golden, self-proclaimed money nerd and personal finance geek. And welcome to Personal Finance Made Easy. I created this channel to help you win with money by making concepts such as budgeting, saving, and investing simple and easy. Today I want to talk about financing options for your rental real estate investments. But before I do, please take a moment to subscribe to my channel and hit that notification bell so that you don't miss out on any future videos. And give me a thumbs up by hitting that like button right below the video. It helps out my channel tremendously by letting YouTube know to promote the video to other viewers. Now, without further ado, let's get into today's video. Today, I want to talk about 7 financing options that you can use to purchase real estate. Now, some of these aren't just financing options, as you'll see in this first point, but I want to give you 7 ways in which you can approach buying your next or first rental real estate property. Now, the first way is using plain old cash. Yep, you heard me right. Cash. You can either buy a property in cash without financing it at all, or buy it with a traditional mortgage. Now, either way, you're gonna have to come to the table with some money. If you purchase it with cash, it's pretty evident you're gonna have to have some money. And you can use your savings in order to do this. Now, with a traditional mortgage, the lender or bank is going to require that you bring a down payment to the table. And usually it's about a 20% down payment. They want to see that you've got money invested into the deal just as much as they have money invested into the deal. So your first option, just buy it outright in cash. If you've got money that you have available to you that you can use to purchase rental real estate, you can buy it with cash. I don't necessarily recommend that unless it's a lower cost home that you're purchasing. And the reason that I don't recommend it is that it's really going to take away from your cash on cash return that we talked about in the calculation video I did a few weeks ago. The other reason is because real estate is one of those investments in which you can leverage using other people's money in order to purchase real estate. And so it doesn't really make sense for you to use all of your cash to purchase real estate when you can take that cash and split it up and use additional funding and purchase multiple properties with generally the same amount of cash. Let me give you an example. Let's say that you've got $30,000 to invest. You can go out and purchase one property for $30,000, similar to what I've done in one of my previous examples, or you can take a $10,000 down payment and split it over the cost of 3 different homes. Now, you can do that as long as that $10,000 is approximately 20% of the total value of the home that you want to purchase. So in this example, if you were purchasing a $50,000 home, that $10,000 would be 20% of that $50,000 home. Now, it may be a little bit difficult for you to get a mortgage, a traditional mortgage, on the remaining balance of that $50,000 home, but some banks will allow you to get those smaller mortgages. You just have to shop around and find a bank that will accommodate you. So in this example, you can either purchase a $30,000 home outright in cash, or you can take that $30,000 and purchase 3 $50,000 homes using the $10,000 as a down payment on 3 different homes, equaling $30,000, and getting a traditional mortgage for the remaining balance of those 3 homes. Now, that's pretty self-explanatory. Those are 2 ways in which you can purchase rental real estate. But let's say that you want to be a little bit more creative and you want to use more of someone else's money, or you want to be able to use a different vehicle. You may not have enough cash saved up to purchase a home outright, or even have enough money to put a 20% down payment down. In that case, you can get creative by using other real estate to finance your next real estate property. That's right. You just have to make sure that you have enough equity built up in the property that you want to use to purchase your other real estate property. This can be a primary residence, or it can be another rental. It doesn't matter. As long as you have equity in that property, you can use that equity to purchase another property. So let's talk about ways that you can do that. The first is called a cash out refinance. So if you've got a mortgage on the property that you'd like to use, you can do a refinance and pull cash out of that property that you can use to purchase the other property. The second way is for you to get a home equity line of credit on the property that you have equity built up in. Now, let's talk a little bit about how this would work. Let's say that you have a property that's worth $100,000 and you have a mortgage on that property that's been paid down to about $50,000. So in order for you to pull the equity out of that house, you've either got to get a home equity line of credit on that house that takes advantage of the additional equity that you have, or you've got to refinance that property and pull cash out. Either way, the bank that you do the refinance with or the home equity with is going to require that you not use any more than about 70 to 80% of the home's value. So in other words, if that $100,000 home or if that bank only will allow you to pull out 70%, then you can only go up to $70,000 on that home. That gives you about $20,000 between the mortgage that you already have of $50,000 and the $70,000 that the bank will allow you to go up to, or the 70% value that the bank will allow you to go up to. So you can cash out and pull out the $20,000 minus closing costs on the loan, or you can get a HELOC and pull out the $20,000, which you will have a few costs on that loan. Either way, now you have $20,000 in which you can use as a down payment for another property. I've used a HELOC before on my properties and have used my primary residence to be able to purchase additional rental income. All right, let's move on to the next one. The next way gets a little bit more creative. Not a lot more creative, but a little bit more creative. And it may be a way that you're not necessarily familiar with. I know I wasn't when I first started investing in real estate, but it's called self-directed IRA. You can use retirement funds or self-directed IRA to purchase rental real estate. The way that you are able to do this is you have to have an IRA of your own with a self-directed custodian, a custodian that will allow you to self-direct the investment options within that IRA. So some of you may be familiar with a regular IRA in which you're using that money to invest in the stock market, or a 401k which you've rolled over into an IRA. Well, this is similar to that, except a self-directed IRA allows you to invest in whatever type of an investment you'd like to invest in. My wife and I have used self-directed IRAs to purchase real estate outright. The thing about self-directed IRAs that you have to remember is that when you purchase the property, your IRA is actually purchasing the property. So the IRA has to purchase the property, the IRA has to pay for any repairs, the IRA has to have enough funds in it to pay for the utility bills, all of those expenses that we spoke about in the video that outlined all of the operating expenses. So you just have to keep that in mind when purchasing that property with the IRA. You can't use any of your own personal funds to rehab the property or anything to that nature. The IRA itself must do that on behalf of the IRA. It must rehab the property. It has to be able to pay for the operating expenses, so on and so forth. So just keep those things in mind if you use a self-directed IRA. The next way that you can purchase rental real estate is by using owner financing. Now, owner financing is just as it mentions, just as it sounds. You would go to the owner, and the owner who is selling that property may be willing to finance the property for you. Now, you may be asking,
why would he do that? Why would a person do that?
Well, let me give you an example from my perspective. Let's say you wanted to purchase one of my rental real estate properties, and I'm really ready to get out of the management business. And the way that you would do that is you could come to me and say,
hey, I'd like to purchase one of your properties, and I'm interested to know if you're willing to finance any of that property.
Now, if I own the property outright, then I have the opportunity to finance that whole property. Let's use the property that I do own as an example. You come to me and say, hey, I'm willing to give you a small down payment and ask that you finance the remainder of the property. The reason I would do that is I would basically become the bank on this property. So I would have an attorney write up a note, an actual mortgage on the property, but I would be the bank. You would be making payments to me. Now, the beauty of that is I would get money and interest on the amount that I'm financing. And if for any reason you no longer make your payments on that property, I still, as the bank, have the opportunity to foreclose on that property and take ownership again. Let's talk about the next way. The next way that you can finance property is using a popular method called the BRRRR method, which is buy, rehab, rent, refinance, and repeat. Let me go over that again. You buy the property, you rehab the property, you rent the property out, you refinance the property, and then you repeat the process. Well, that doesn't talk to how you would buy it. The way that you would do this is you really want to buy a distressed property, a property that's not in good shape and needs rehabilitation. For you to be able to make money using the BRRRR method, you have to buy that property at a very discounted rate. You're basically doing a fix and flip, but you're holding on to the property. So there's got to be enough money within that property for you to be able to make a profit over what you purchased it for and the money that you're putting in as a rehab. Now, this method you can expand on, and I may need to do a video specifically about the BRRRR method. This is a little bit more complex method, and I'm gonna go over it really quickly at a high level so that you know how the strategy works. But you can get a hard money lender, which is a different type of a lender who will lend on a property that needs rehabilitation for a short period of time, usually between 6 and 18 months. They'll provide financing for you. Basically, you would get that hard money loan, you would be able to rehab the property, get a renter into that property all within the 6 to 18 month period. Once you get that renter into the property, you go to a traditional bank and get a loan on that property. Now, the goal is that your rental rehab would allow the property to appraise for more than what you took out from the hard money lender. This way, you would be able to pay the hard money lender back all of their money. You would be able to own the property, and you would just use the rental income to repay the bank. Again, that's a more complex topic. We may need to break that down in a different video, which I'm happy to do. But let's talk about the final method of purchasing rental real estate. And this one is pretty straightforward after that hard money lending topic. But basically, the other way is to just partner with another investor. So the way you would do this is find another investor. Say you want to purchase a property and I'm an investor. You can approach me and say, hey, I found a great deal on a property. Would you be willing to finance the property and I would manage the property? In that case, I would be your financing person, and then we could structure a deal where I can get some ownership in the property, or I would become the bank for your investment and you would pay me an interest back on that property. Either way, you can structure that deal in a way that it makes sense for both of us to profit off of your real estate deal that you found. But this is a really popular way for new rental real estate investors to get into purchasing a property without having to come to the property with their own money. Generally, the types of partners that you'll want to get are family members or friends, acquaintances that you know very well who trust that you would be responsible with their money and would be willing to give you the money that you need in order to make the investment. So these are ways that you can use in order to purchase rental real estate without a lot of money or with money if you have it. But I wanted to give you this overview so that you would be able to start to make offers on rental real estate that you have done the analysis on. All right, I hope that helps. I'd be interested to know what ways you have been able to finance your real estate deals. If it's not on this list, I love to hear how you have financed your deals in the past. Feel free to leave a comment. Let me know how you financed it. Or if you're interested in more details about one of the ways that I've talked about in this video, leave a comment below and I'll make sure to do a video or answer that comment. Until next time, you keep living on purpose, pursue your passion, and get the gold.